Hey, I'm Chris Perras, Chief Investment Officer at Oak Harvest Financial Group in Houston, Texas. This is our weekly Stock Talk podcast, but we're not in the office. We're not in a studio. Yes, we're at my home. We're in my kitchen. This is the second time in about a year we're doing a cooking segment along with our stock segment. So I apologize if there's some interruptions. I have two golden retrievers that might wander in and out of the view here. Their name's Stoli and Bailey. You put them together and you get a white Russian. So that's how we named them. They're white golden retrievers, English cream. So hope you're here for a while. Watch us, listen to our stocks, learn a little bit about mole. We're talking about some Mexican food today. I'm making pork mole enchiladas. I am cheating. I don't make my own mole. For those of you who like authentic Mexican food, a lot of people make their own mole, which is a very long process. It has anywhere between 30 and 100 ingredients. I don't have that kind of time to make that by myself from scratch. So I cheat. I order some stuff online from Amazon, mix it up, doctor it up, and then make some enchiladas. So this might take us about 30 minutes to talk stocks, talk some food. Hope you enjoy it. Looking forward to some comments on this. So first step, I'm gonna go back over here to my range. Their dogs are going crazy outside. I fed them, but apparently they don't like to be left out. So you're gonna see them wandering in here in a little bit. So we got the beef tallow here that's gonna melt down very quickly. And I'm gonna add some onions I minced last night. It's almost 2 cups of onions, both red and white. We're gonna sweat those down in here for a little bit because I like a lot of onions in my enchiladas. That'll take a little bit of time. While we do that, I want to talk about stocks because that's really what I do at Oak Harvest with the team, which is now 5 people on the investment staff. We've gone from 2 to 5 in just about a year. So we've expanded pretty dramatically to add some additional products, and we're going to add some new products in the coming year, which are going to be very exciting things that very few advisors can do in-house, and very few advisors have the tools out of house even. It's going to be a great opportunity for our clients and prospects going forward into 2024. So let me stir this up a tiny bit here and turn it down, and I'll come back over and talk to Eric and catch you up on what's going on in the markets. Because back in late June, we did a segment, and it was, I think the S&P 500 was at 4,300. It was late June, early July. And we said, we're taking the summer off, which was figuratively, it wasn't literally. I told our team, if we were running a hedge fund, I would pretty much say, hey, let's call it the summer. Let's hedge the whole thing up and, go take some vacation, because the market had been up almost 20% in the S&P 500. The NASDAQ stocks were up 35%. Even the Dow stocks, I think, were up, 5%. They had positive returns. So since then, the market actually peaked in mid to late July, 4,600. And we've declined into early October, where we hit 4,200 just last week. And early last week, there was a lot of negativism around the economy and inflation. Sure enough, there was some data on Friday that looked like a great jobs report, and the doomsayers were out there talking about inflation ramping still higher, and that we were going to have to increase rates even higher. Yes, interest rates went up, but sure enough, the market's a reverse course from being down 40 or 50 points on Friday morning to closing up about 50, 60 points Friday afternoon. Almost exactly the exact opposite pattern that we saw in late July when the market peaked out. And there was lots of enthusiasm and optimism about AI and earnings. Sure enough, this last Friday on the jobs report Friday, market opened down big, closed up almost exactly opposite. So, people are trying to trade things short term. Good luck with that. But so far, very normal year, bottoming when it should. Early October, should be a couple more weeks of this messiness. We'll get through some earnings. They're likely to be kind of revised down. And then people are going to look out to 2024 where hopefully they'll be optimistic, which they usually are. And you usually get that fourth quarter rally, which is usually late. It's usually November, late December. Then usually beginning of the year sell-off, while people are taking tax gains. And then you get another ramp up into the end of the first quarter. So that's kind of what we're looking for on the stock side. No different than what we talked about for the last month. No difference than what we talked about last June and July when the market was at 4,600. So it's playing out very normal, not fun, but normal. So let me go back here and stir this. So yeah, it's probably a lot of onions in here, but they'll sweat down, they'll reduce a little bit, caramelize a little bit. Smells great. The liquid will create some flavor to go in the rest of the enchiladas here as we move along. So as I said, moles, it's a thing of Mexico. Each region has different ingredients that go into it. It's usually a combination of spices that have been toasted, and then a combination of chilies, at least 2, sometimes 5, 6, 10, that have been dried and chopped up and ground in to make a paste. They put that together, and then they'll take some dried fruit a lot of times, chop that up, grind that in, and then they thicken it using nuts and seeds, excuse me, and they grind that up into make it a paste. So you can buy moles in paste form online, and then you can dilute them down with whatever you want. That's what I do. I cheat because I don't have time to do all those other steps between 30 and 100 ingredients. I add some beef stock to it, and that's what this is, just the mole mix by itself on its own, thickened up already. And I cheat to make it even bigger, and I use some just basic enchilada sauce that I make from a packet. Tomatoes, water, sauce. I'll mix those two up, and then I will cheat a little more, and I'll take some of the drippings from the pork that I slow smoked for 12 hours yesterday and shredded. There that is, all shredded up, seasoned up previously. And this will become the sauce that goes into the pork mole enchiladas. So let me get some garlic to throw in here out of the fridge. And I'm trying to think, people who tune into our videos usually see a lot of stats. I don't have a lot of stats for you, but I saw something super interesting yesterday on LinkedIn, just adding some garlic here for a little more flavor. LinkedIn, it's generally a business site, but there are a lot of people who post a lot of good economic content that's not government statistics, but just stock data. And there was a piece yesterday, and I'll post it later in the week. Maybe we'll attach it to this video. As I said, sentiment was getting very negative last week, and a lot of technical traders will look at things called the put-call ratio and other sentiment data. We referenced the investors' intelligence data, bears to bulls data, and stuff like that. These people were referencing the put-call ratios. Puts being, if you're buying puts, you're concerned about the market, you're hedging, you're buying insurance. If you're buying calls, you're optimistic about the market, you're starting to speculate that things will go higher. So when the put-call ratio is high, negativism is high. So a higher put-call is more people betting negatively on the market, and therefore is contrarianly bullish. You usually get those big high numbers when the market is down and near a bottom. Sure enough, on Friday, it had the highest reading we've seen in like 5 years, somewhere around there. The data shows during the time periods, each time it's reached this level, that the return, the average return over the next 6 months was over 14%. And the number of times it's actually hit this level, it had a 100% hit rate of reaching that average of 14.5%. No guarantees ever in the stock market, but it just so happens that that 14.5-ish% return over the next 6 months, which would project out into, say, mid-March, late March, early April, is almost exactly what our team's optimistic outlook would be for the first quarter of next year. No, we don't have a magic crystal ball, but we do basically make our forecasts based on data that we've seen historically, whether it's from the jobs market, the bond market, sentiment markets, and we kind of triangulate. Volatility markets is one that I look at all the time. Triangulate where the market can go under optimistic scenario. It's so far playing out as we expected. I expect it to do more of the same, albeit not with low volatility. The next 6 months are likely to have relatively high volatility, but I still have a positive outlook on November, December, and into the first quarter of next year. So let me stir this again so it doesn't burn. Get all that going.
But Chris, I saw a comment on the YouTube you released yesterday.
Yep.
It said, when are we going to hit 4,800?
Yeah, I saw that too. It's so funny. So, you know, we've talked about that in the past, and you know, there are no guarantees, obviously. In an ideal world, where normal played out as it has all year, you know, you can get near 4,800 right into the end of the year. I mean, I'm probably like, you know, New Year's Eve, something like that. I'm not saying that's going to happen, but that would be actually what the normal pattern would be. We got some cilantro here too. I just added some green onions, adding some cilantro. There's that. So that side, gonna add the mixture that was the drippings from the pork to there. And this is just this is not canned enchilada sauce. It's made from a packet, but it's I think so much better than most of the canned enchilada sauces out there. It's a great starter. And then we're gonna mix in some of the mole, which is usually, like I said, it's all sorts of chiles, poblanos, you know, sometimes it's habaneros, cayenne, nuts, all sorts of spices, and it's thickened, you know, using the nuts. But I like to dilute it. And you know, most people think of moles, they think of chocolate. All moles do not have chocolate, but the darker ones tend to have some for the sweetness. If they don't have chocolate, they'll normally have fruit to give it some sweetness. So I'm making these for work. And you know, some people like spice, some people don't. So I'm trying to keep it, you know, kind of medium as far as spicy. We actually had a contribution from one of our financial planners to the cooking process. Lizzie, thank you, and your parents from Nebraska for shelling out some of the homegrown peppers she brought back from Nebraska. Here they are chopped up. I smoked them. They're habaneros. I think they're serranos, poblanos, jalapenos. There might have been some cayennes in there. I think she brought me like 5 or 6 different ones. That's gonna go on top at the end for some of the people who like spice. Troy loves spice, so I'll save him some enchiladas that have a lot of spice to it. So that's,
you grow your own spices in the back, right?
I do. I grow my own tomatoes. I grow my own peppers. We had a drought here in Houston, which is generally pretty good for peppers, but it got a little too hot. So this is a can of fire roasted tomatoes. I didn't roast my own tomatoes. It's got liquid in it. Actually, I need to pour some of that off. That's got a lot more liquid than I thought. You know, more flavor, and yeah, it's from a can. You know, I didn't do it myself. You know, I'm busy worrying about the markets most of the time. I do this to relax. So if I can use someone else's product, it's got good flavor, it's easy, you know, I do it. So 4,800, you know, I think we said it early. I think I said it last October, you know, when the market was making its lows, that the optimistic scenario from volatility and stuff had the market nearing new all-time highs into the year end of this year. Do I think it gets there and stays there? No, not for long. You know, there's going to be, I think, a fair amount of volatility coming in December, coming in the first quarter, but maybe in a good way. You know, I don't see it playing out as like 2017, where volatility was high and then it just collapsed and just kept ratcheting down to, I think the VIX got to 7.5, which is historically unheard of. Normally it gets to about 12, and that's about as low as it'll go, occasionally 10. So I'm not expecting, you know, a 2017 just stair-step market in 2024. Too much economic uncertainty. We've raised interest rates too much. There's a lot of geopolitical tension between China and the US. Still inflation concerns because of what's going on with, excuse me, oil, with labor markets, and with the number of labor strikes, whether it's the auto workers, or now I think there's the healthcare workers out at Kaiser Permanente in California. All these things are inflationary to the markets. EVs, very inflationary because they cut back on the number of production of internal combustion engine vehicles, which they've been making for 60, 100 years. Now they're trying something new. Costs go up. You know, it's inflationary to consumers. Now, the good news is for retirees or near retirees, there's actually now a return on bonds. People are saying it's the end of the 60-40 portfolio. Our team does not agree with that because the 40, which is usually people talking about bonds, our team has had our clients who are in a blended portfolio of 60-40 or 70-30. That bond component that we have has been largely short-term solutions. So government bonds, 0 to 2 years, a mutual fund that we use, 0 to 3 years in duration. So as interest rates have been going up, the price of the bonds haven't been going down. They reset. God forbid you bought the Austrian 100-year bond that was issued 5 years ago. It ended up getting priced at like 200. It now trades at 60. So if you bought it at the lows of interest rates, which was the high on prices, because bonds prices move opposite of interest rates, you would be down 60, 70%, which is every bit as bad as a bad stock. So if you keep your maturity short and you're not getting greedy trying to stretch for an extra 25 basis points, which we had a lot of prospects who said, hey, we want more on our short-term money 2 years ago, 3 years ago. They didn't like that they were only getting 25 or 55 basis points. That's a 0.5% on their money. So they decided, we're going to take the money away from you or, invest it in a 5 or 10 year instrument that paid you 1%. The longer you've gone out in duration, that's, 5, 10, 20 years, the more money you've lost on a price component over the last 2 years. Now, you'll get your money back if you hold that bond all the way till the end, if it's a treasury, but along the way, it's going to look like 100 down to, I don't know, 60 or 70, back up to 100. And you'll just get the coupon, every quarter or every 6 months, however it's paying you along the way. So you're going to have statement losses if you have those long-term bonds. If you hold them to maturity, unless you own like junk bonds and stuff, you own treasuries in the US government, you're virtually guaranteed that you're going to get your entire principal back at the end of the period without a default. So we've kept the maturity on our bond portfolios as short as we can. Now you can get a 2-year treasury that yields over 5%. 6-month treasuries, I think, might yield even more than that, 5.25, something like that. So, okay, so we got the ingredients going over here at the stove. I'm gonna walk over here. You might see the dogs show up. I just had to let them in. They wanted to be part of the filming. That one's Bailey right there. She's the girl, and Stoley's hiding, but he'll be back over here. So here's the pork, already seasoned, chopped up, shredded. So viewers, this is probably one of the cheapest meals you can ever make to feed 20, 30, 40 people. This 12-pound pork shoulder was on sale. It was 89 cents a pound, at Randall's, which is one of the more expensive grocers here in town. So you can find ways to make a lot of food for your friends who generally love it. You can do it economically if you look around. So let me go ahead and push this stuff in here. I'm gonna probably make a mess. I'm doing this while my wife is out of town. So it's just me and the dogs, and Eric drove over and this isn't working. So I'm gonna reach over here and get some other stuff. Yeah, this pork shoulder took about 12 hours. I slow smoked it. Got it up to about 205 degrees, then left it wrapped, let it set for a couple hours to let the juices come back into it, and then shredded it last night. And I don't even think I'm gonna use all of it because I'm gonna save some of this and just take it to work like this. And then got some street taco sized tortillas over here that are white corn. And if some people don't like enchiladas because all the cheese and the spice, they can just make some of their own pork tacos. So no, I do not make my own tortillas. I don't make my own masa. If there's someone out there who wants to volunteer and send me a sample, he send it to Oak Harvest or volunteer, and maybe next time we can do a group cook. So I do like cooking for other people. I tend to take over people's kitchens during the holidays instead of sitting around. I kind of have to be doing something, so I'll end up in the kitchen, generally with whoever's cooking, trying to learn and trying to be helpful instead of just sitting around. So yeah, a little more here. So gonna have to mix this up a little. So right now it shouldn't be too spicy because there's not a lot of peppers in there. I mean, I did put some on top when I was smoking it, but the oils do smoke down and you lose some of that. So we're going there. And so trying to think here, people ask, well, if you have a positive outlook on the markets, what do you think works? So what works at the end of the year? Normally what would work would be what's been working year to date, which would be largely energy stocks, large cap technology stocks, large cap service stocks like Netflix and those. Last week we had a bunch of the staple stocks and utility stocks fall off dramatically. It was a little more than normal, but those stocks usually do not perform that well at this part of the economic cycle because interest rates have gone up. People are worried about consumer spending, and the dollar has gone up dramatically since July. And so, there was a lot of talk about studies about all these weight loss drugs are going to make people eat fewer salty snacks or go to McDonald's less. That's all anecdotal evidence, and I don't believe any of it for a moment. I think it's a convenient excuse. These stocks were going to go down anyway. And once they start going down because of the dollar going up or consumers cutting back because they raised pricing too much last year because of inflation, then they come up with all sorts of excuses. So they were down more than I expected, but that's because they largely are now packaged in ETFs. So whether you like Pepsi or not, or Coke or not, the stock is part of an ETF. And if someone wants out of that ETF, they sell the ETF and your Pepsi goes down, your Coke goes down, your McDonald's goes down. They're all one stock because they're all on that ETF. So, we try to use a lot of single stocks in our portfolios. We own some of those names. Those, were down last week with everyone else. So, because we own broadly diversified portfolios currently for our clients. So let me go back here, stir this up, start to season and flavor. And then the last thing we add is cheese. And I use a combination of just Mexican cheese, and then I use some Cajito cheese, which is just a dry Mexican type of cheese. It's almost like a Parmesan from Mexico. I don't want to make these too wet because then they get kind of sloppy and they're hard to serve. So just enough to season the inside, and I'll save the rest of it, of the sauce, can it for later. So I'm trying to think of other stock things questions we got. We did a piece last week on the government shutdown, which I think lasted 12 hours or something, or maybe it was averted. Historically government shutdowns are actually good for the market. The less government operates, historically, the better the stock market is done. So usually when the folks in DC are on vacation, the stock market goes up, and the stock market tends to go down when they're trying to do their business because they're generally meddling in things that create friction for the public equity markets, the public bond markets. So it's not that they're not trying to do their jobs, but anything that increases the marginal cost of a company to do business ultimately takes away from an investor's return. So the Fed raising interest rates, that interest that a company has to pay on their income statement is after all the expenses. They pay their employees for labor, they pay the cost of goods sold to make the product, and there's an interest line. If that goes up, the shareholder doesn't get paid until all those other people get paid. So if your interest costs are going up, the money left over, the cash left over for the investor in equities goes down. So these companies with really high debt loads, those stocks have been going down pretty significantly over the last 6 months to a year and a half, because this interest rate increase, even though they may have fixed cost debt currently, eventually they're going to have to refinance that and their costs are going to go up, which will hurt the equity investor. Increased regulation, whether it's banking or energy. Increased regulation increase the cost of doing business. Those costs usually are passed on to consumer by way of inflation, or they come out of the investor's incremental return. So your marginal return on invested capital goes down. So you're looking for situations where the marginal cash you're going to get back from each incremental dollar the company spends is going up, not down. This part of the economy, that's really hard to do, which is why the market has been struggling for the last almost 2 years between essentially, I guess the low was 3,600, the high was 4,800. We've traded basically between 4,200 and 4,600 now for almost 2 years. So there's going to be resolution over the next couple months. We think it's up initially for the next 6 months. Then who knows what happens in 2024. We'll update you as we get closer. But our crystal ball, although we can try to make 18-month forecasts, we try to stick to maybe 6 months at a time. So this is reducing down. I'm going to come over here, start adding one of my favorite things in the world to eat, cheese, which I try to stay away from because I can't not eat enough of it. So that's just the Mexican blended cheese. And then I have the massive Costco sized portion here. Eric, you got any topics you can think of off the top of your head here while you're filming this? I'm gonna put you on the spot because it's, I don't know how many people are, well, if we release this today, I know no one would be watching it because here in Texas, it's OU's playing UT right now and it's the second half. So all I think anyone in Texas is doing is either partying at the Texas State Fair up in Arlington or they're at the football game. So it's all quiet unless you're up there probably. So I think Texas A&M may play later today too. So you got any questions here? Some people ask about gold. It's not, to me, a retiree investment because it doesn't provide you any cash. But if you're concerned about the markets and safety, I would say, gold over the next number of years is as good as safety place as you can put it. It's not going to provide you any cash, right? Which, right now your cash buying treasuries and stuff, you can provide you 5%, 5.5%. So, don't sneeze at that. But, people do ask me about gold. I haven't liked it in 20 something years. If you're going to like it, probably the next 3 to 5 years is as good a time as any to like it. Should you buy an ETF or should you take delivery of it? Just remember, most of these ETFs most of them don't actually own the physical metal. They own contracts and financial instruments to replace the physical metal. So if you're really concerned about like the financial system and I hate to say the end of the world trade, you want to buy gold and you want to take delivery of it, which can be costly because of commissions and insurance purposes and storage purposes, but that's what you would do. And there's some online wholesalers who will sell it to you at a reasonably inexpensive markup. So that's my thoughts on gold. Let me think here. What else do we like besides kind of technology and growth stocks? Some of these conservative stocks are finally getting interesting. I've seen some data on, utility stocks, which we don't own a bunch for clients just because there's no growth. But as the economy finally slows and inflation has peaked, right? The data we look at, inflation is running about 1.3% looking out a year. In fact, the data that the Federal Reserve looks at, if you market real time, like 3-month trailing average, it's down under 2.5%. I think it's now 2.1%. Now the trailing 12-month data is like 3.9, but that's not what's going on in the markets right now. What's going on, they've got inflation down. Right now, it looks like the Federal Reserve doesn't care, or they're just deathly afraid that it comes popping back. So they're keeping real interest rates much higher than they've been since the great financial crisis. They're back to, really normal to high levels, actually, the real ones. And, the fear is into the end of the year, they might make a mistake and keep them that high and cause a congestion in financial markets. I don't think they're going to do that this year. I think Powell learned from his mistake in December of 2018. And if you recall, the market dropped like 20% from October into Christmas Eve. And then Powell said, hey, I've kind of made a mistake. And then the markets were off to the races in 2016. So I don't think he makes that mistake. I think the upcoming Federal Reserve meeting in late October, early November is an excuse. And by then, the markets are starting to already exhale. And what normally would happen is the markets would start to reverse higher into the second half of October after option expiration in October. And then they would use the Federal Reserve's meeting in November as an excuse to vault even higher into Thanksgiving. We do have economic cycles. Our title for this year's piece was the old normal. And that means we will have recessions. Stock market will not be backstopped by the Federal Reserve, and expect more volatility relative to the last number of years in the markets. So let me turn this down and start stuffing some of these mole enchiladas. So we're gonna stuff these enchiladas here, if I don't burn myself. Eric actually, when he was changing batteries, was asking me about the difference between being in the accumulation stage and the retirement stage. And they are different, right? When you're in the accumulation stage, you actually should probably want a period of 10 years where the market goes nowhere, and you're contributing to the markets every year, right? You're dollar cost averaging, because you're not going to need the money for another decade, 20, 30 years. And but if you're in retirement or near retirement, you have different goals and objectives, right? Safety of principal might be higher. How am I going to generate income in retirement? How am I going to cash to pay bills, to pay rent, to pay healthcare? Those are the things on your mind, and those are dollars, as opposed to when you're accumulating, you're worried more about percent returns. In retirement, you can't spend percent returns. You can only spend dollars. So, one of the things I've talked about to our clients and prospect is, from an investment manager standpoint, one of the key things you cannot do, or I abhor you to try to prevent yourself from doing it, is going back and forth, looking at your portfolio, and when the market's down, calling your advisor or thinking to yourself, I lost $200,000. And then when the market's up, looking at your portfolio and comparing it to the S&P 500 or the NASDAQ and saying, I'm only up 10% and the NASDAQ's up 35. And going back and forth, I'm down 200, but I'm only up 10%. You will never reach your goals and objectives by doing that. You pick one or the other. You manage it for cash, or you forget about the cash for a while and you manage it for percent returns, which are measured over long periods of times. Knowing that you can't spend those percentages, you can only spend cash in retirement. It's a timely question because I actually got off the phone with a fraternity brother of mine. We were catching up, and he's kind of semi-retired, owns a chain of car washes and stuff. And we were talking, he asked me my thoughts on the market, and he's my age, and I said he's semi-retired. He has cash coming in from his businesses, and he's normally historically really aggressive in the stock market. And for the first time in quite a while, I'm like, hey, Mike, what are you doing? And he said, for the first time, I'm like, I can get 5.5% on a 3 to 5 year bond. Corporates are 6%. I don't need more than 6% over the next, 3 to 5 years. That cash will be great for me. So I was glad to see him thinking that way. But, once again, he's near or in retirement versus someone who's 20 or 30 or 40 years old. My kids, 25 years old. The money they're making now putting into the market should be insignificant relative to their whole life. They should actually be rooting for a lost decade of returns, where the market actually does go from 4,800 or 5,000 down to 2,500 and stays between 3,000 and 4,500 for a decade. Which is essentially what happened after the dot-com bubble in 2000 through the great financial crisis into 2011. It just bounced around, but that bouncing around like it or not, if you were a baby boomer and you were working and still had your job, you were dollar cost averaging that entire time. And lo and behold, the markets broke out to a new all-time high in 2013 or 14 and have compounded at, 10 or I think 12% ever since, which, you had a decade of just kind of putting money into the market and not making much. And then your returns have all come the last 10 years. So now you're in retirement and you're like, I've got this big bundle of retirement savings. I own my house or my mortgage is 3%. Now you should be worried more about cash returns and return of principal as opposed to percent returns of, my accounts are only up 5% because value stocks and dividend stocks are up 2 or 3% this year. But the NASDAQ is up 30%. Hey, Chris, investment team, why am I not up 30%? And I'm kind of like, well, because last year, those stocks were down 35% and those dividend stocks were flat. So in trying to go back and forth between the two styles, you're never going to catch the swings correctly. So you need to pick a asset allocation, stocks and bonds, and then types of stocks, whether they're dividend growth stocks or growth stocks that don't pay much dividend, and stick with that and make those allocations changes occasionally. But don't try to move huge chunks of stocks to bonds all the time. Don't try to move huge chunks of money from growth stocks to value stocks, trying to time that one. It doesn't work. There's no investment manager who can do it consistently, right? And I've been doing this 30 years, and I honestly, the data would show I'm pretty good at actually seeing these moves in the overall market, but even so, executing on them in a way to make significant, meaningful differences in your portfolio is difficult, particularly if you're talking about having hundreds of clients with differing tax objectives, someone's 55, that's a different outlook than someone who's 85, right? And you're going to move everyone's portfolio around just because of your outlook for the next, year or two. And it really shouldn't change probably for the 55-year-old. Maybe it changes for the 85-year-old because they need the money or whatever. So if you're 25, like I said, you shouldn't be worried about it at all. You should be worried about saving, as much of your disposable income as you can, putting in the market, deferring things that you just want to do for a whim, that gave you immediate satisfaction and gratification, but down the road you're like, well, I wish I had that money because it could have compounded and I could have bought a house or something like that. No, don't give up on all vacations when you're young because those are memories you'll have your entire life. Okay, final stage. So we're gonna stuff these enchiladas, and I've got a little known secret from HEB here. These are called mixala tortillas. So they're part corn, part flour. So they've got the flavor of corn, but they roll like a flour. The problem I find with corn tortillas, you usually have to double them up because they crack because the texture's wrong. This, best of both worlds, 24 count, I think it's like $2.50 over at HEB. I've never seen them anywhere else. And they're kind of hard to find there because they have so many different types of tortillas here in Texas. Look for them though. So I'm gonna stuff these for everyone for work. Just enough that I can roll this shut. It's got enough liquid, it should stay closed. I'm not gonna make these really big because I'm gonna double layer everything. I actually thought I probably had made more than this, but maybe it's because I left some of the pork just for tacos. So I told everyone it's gonna be first come, first serve. Hopefully they're not gonna fight over this. They're usually pretty good at sharing. So trying to think of market stuff left. As much as we haven't heard the term unprecedented much this year, not in the stock market. It has been pretty much in the bond market. It has been near unprecedented. The losses are as close to the losses, I think, of the great financial crisis in stocks, because the Federal Reserve, kept rates at 0% for a long time. And it really is kind of perverse and unfair in that they incented people. The government sent checks out to everyone, told people to spend money. They shut the economy down. Then they told everyone to, save money, spend money, and now people talk about this excess savings, rate, which is one of the most absurd terms I've ever heard. Only an economist can dream that one up, because if one looks at the United States, everyone knows we're anything but a country of savers, and certainly not excess savings. All they're talking about is a polite way to rename and market. The government did way too much, handed out way too much money during the COVID crisis. And some of that money and some of those handouts haven't been spent. So it now's been spent. I think it's the savings rate is down to 3.5%, which I think is near where it normally is. But the next time you hear that excess savings term on CNBC or anyplace else, turn it off, boo, hiss, throw something at your TV, don't break your TV, and know that there's no such thing as excess savings in America. And in most countries, there's not. There's a lot of discussion about we're massively in debt. Yes, we are. It's largely on the backs of the last 40 years of politicians on both sides in Washington deciding to borrow money we didn't have and spend money we don't have. So, the national debt is 33 trillion and climbing. That does not include the unfunded liabilities, whether it's Social Security and healthcare benefits that we promised everyone. When you add that on, I can't remember if the number is 100 trillion yet or not, but it's a lot. So, the country will pay a price for all this borrowing, and it won't be the generation that borrowed the money. It will not be the people who are currently leading the country who led us into this debt burden, because they will largely be dead and gone by the time it becomes an issue. So it will be left apparently to the Gen X, which I'm part of, the millennials, and Gen Z to figure out how to unwind or pay off or start to pay down the debt. So, people ask me, well, how are they going to do it? I don't like any of the answers, but the easiest answer to me is, a wealth tax on transition. So you get rid of the stepped up basis of a lot of the wealth transfer and tax it, given that most of the wealth is sitting at the baby boom. When they die and it gets passed on, if it's getting passed on tax-free, it's largely compounded at super high rates the last 20 or 30 years, largely by borrowing and spending. If it gets taxed, if we pay down the debt on the way to the next generation, that's probably going to be the easiest way to do it. That and to rationally extend the beginning of when people take Social Security, when they take these healthcare benefits, because people live longer, right? We're coming up with new ways to extend people's lives. Therefore, the costs go up exponentially. The longer we use these medications, the longer people live. So, I don't think, the Declaration was not written back when people's life, span was 80 years plus. No one ever expected our government leaders in Washington to live past the age of 35 or 40, let alone into their 80s. And there's going to be some big changes over the next 10 years. But we've gotten through this every generation, and we'll get through this. We'll figure it out, because that's what we do as a country. So, trying to think of other topics here. I'm going to work on the second layer. What else you got? Here's Stoli. Here's Stoli the polar. We call him the Stolar bear sometimes because he looks like a polar bear. So he's quite flexible. He's 9 years old, and he's probably one of the prettiest dogs I've ever seen in my life. And yes, I'm biased, but we tried to get another one, but our breeder, his parents stopped breeding and stuff. So Bailey was a home breed, so from a home breeder, and she is a super smart dog, and all she wants to do is hunt. So trying to think here as I finish this up, what else? We're going to be having some more live streams coming up. We'll probably talk about the markets a little more. We've already talked about the fourth quarter a bunch in our live streams, and I tend not to I don't change my story much unless some of the data starts to change a lot, and it hasn't. So, people ask me, have you changed your mind? And I'm not sure why they asked. Maybe it's because the market went from 4,600 to 250. Haven't changed my mind. That doesn't mean it doesn't make me nervous. In fact, I haven't been sleeping as much just because when you see something that's going to happen and it happens, the next step is the next thing going to happen as well, right? Okay, we were right, and we actually have had more cash in the portfolios than we normally do. We were carrying, in our model portfolios, 10% in some of the model portfolios, which we haven't done in years. Does that help? It helps in that it gives us some opportunity here over the next few weeks when companies report earnings to, buy some stocks that are down and that we think will perform pretty well into the fourth quarter and first quarter. Does it move the needle? It can move the needle. If they're going to be tech stocks, we know they can move the needle because how much they can return. But remember too, cash is yielding 5%. So it's not a bad place to park money in uncertainty. Whereas there was TINA, there is no alternative for 10 years. There are alternatives now, and we're back to that environment. So active management, I think, will become probably the thing of the coming decade, right? It'll be, passive management now I think is almost 50% of the market, which is why there are these huge moves up and down in these large cap stocks, because so much of the money is sitting in these passive funds. When the money that's actively managed wants to move, it has an oversized effect on the stock overall. So I think Pepsi was down $9 one day last week. I on 4 million shares, which is nothing. So I think that equates to a $20 billion loss in the company on only 4 million shares trading, which is a couple $100 million in stock. And it just, all the stocks sitting at Vanguard or sitting at BlackRock in ETFs and in indexes is kind of parked there in these funds, and it doesn't move, right, unless the index moves. So the incremental buyer or seller who's concerned about the company's fundamentals and might want to sell or buy, they have a big effect, which is a good thing if you're an active manager and you can kind of stay patient. You can wait for those opportunities, and when those negative catalysts happen, but you see them in advance, you're waiting, you have some cash, and you can put some money to work. So patience will be rewarded, I think, a lot more over the next 5-7 years than it has been over the last decade, where the Fed just pretty much came in and backstopped everything. I don't think they want the market to collapse. I think there are way too many savers and baby boomers with a lot of money and influence in Washington, D.C., that the last thing in the world they want is the stock markets to collapse. But that doesn't mean that there won't be recessions, and there won't be a recession. Is historically minus 35% on the stock market. And that's what we had last year in the first half. The stock market went down peak to trough in real terms. So when you look at the S&P, I think it dropped 25%, but inflation at the time was running 8 or 9. You add the two together, that's minus 35% of your money in real terms, kind of evaporated. Now it's bounced back, but relative to inflation, you're still treading water to losing money. So I don't think the folks in DC really want our economy to grind to a halt and stuff. And it's likely to slow down considerably next year anyway, in front of the election, with all the uncertainties about who's running, who America wants running, and what their policies are going to be. So I'm done rolling these. I got, I don't know, how many is this? Like 6, 11, there's a good 20 underneath. So I've got about 35 enchiladas. I've got enough for probably 10 to 15 tacos. This entire meal, when you add everything up, the meat was less than $10. I think the cheese might have been $3 or $4. The total meal might cost for 30 enchiladas, 30 35 bucks. And I'm gonna feed most of the office. So from the bottom of my heart to your mouth, to your stomach, I hope you have a great weekend. Hope you come back next week. We'll pick up the investment topics, we'll pick up the news, and we'll get back to talking about the stock markets and your financial situation. From the whole team here at Oak Harvest, the financial planners, the financial advisors, Troy, Jessica, the whole investment team, which is now 5, up from 2 almost a year ago. Have a blessed weekend.